Australia's federal budget dropped on a Tuesday, already running hot with corporate carnage. The S&P/ASX 200 opened cautiously, oscillating either side of flat as traders weighed a Wall Street that had just printed record highs against a domestic session crowded with moving parts. By the lunch hour, the benchmark index was nursing a 0.6% loss, with capital rotating defensively ahead of Treasurer Jim Chalmers' evening statement. The session's dominant distress signal came from healthcare. CSL Limited, the index heavyweight that had already shed 19% on Monday following a guidance downgrade, extended those losses by a further 6% at the open. Brokers at Bell Potter published a note titled "Blood on the Street," flagging that CSL's bearing gross margin weakness had introduced genuine doubt about whether the company can ever recover to pre-COVID margin levels. That doubt is what was repriced, not just the downgrade number. Defense technology was the second front. DroneShield confirmed receipt of an ASIC investigation notice, requiring the company to assist with an inquiry under the Corporations Act, a disclosure that sent the share price down between 13. The budget's centerpiece tax measure, the one Treasurer Chalmers framed around housing equity and intergenerational fairness, is built on a foundation that exempts the largest single pool of investable capital in the country. The government will scrap the capital gains tax discount for assets held before 1985, a 40-year-old concession, and introduce a minimum CGT rate of 30% across all asset classes: shares, managed funds, property, and venture capital. All of that applies to the roughly 19 million Australians in superannuation funds, except it does not. Super is carved out entirely. The Association of Superannuation Funds of Australia welcomed the exemption immediately, with CEO Mary Delahunty describing current CGT settings for super as appropriate and confirming they would remain unchanged. The Super Members Council called it a win for the 19 million Australians with a super account. That framing itself encodes the tension. The government's equity reform is being praised as a win by the very constituency it chose not to reform. The Financial Services Council called it a bait and switch. FSC Chief Blake Briggs argued that the budget discourages investment in shares, managed funds, and high-growth sectors under the guise of housing fairness, while simultaneously shielding the tax treatment of those same assets when held inside superannuation. The mechanism matters here. Capital flowing into super-wrapped structures now faces a structurally lower tax burden on gains than identical capital held outside super, widening a wedge that already existed, but will now be encoded in a statutory 30% floor. The question the exemption forces is whether this is a policy design choice or a political one. Superannuation represents approximately $4 trillion in assets. Taxing those gains at 30% would affect the retirement outcomes of the middle-income cohort the reform ostensibly protects. But the exemption also happens to remove the most politically explosive constituency. Any adverse budget reaction from the super sector would have been deafening. The policy achieves equity framing while insulating the largest asset pool from the mechanism used to achieve it. The unresolved question from the super exemption is whether the 30% minimum CGT floor, applied selectively, actually redirects capital toward housing, or simply accelerates the reallocation of investment assets into super-wrapped structures where the tax rate remains lower. That is the transmission the budget assumes away. Financial advisors will now face elevated client activity, particularly around pre-1985 assets and asset restructuring into super-eligible vehicles. The FSC's framing of 14 legislative reforms, reducing compliance costs by $780 million per year, was the government's concession to the industry. But the CTT redesign creates new advisory complexity at the same time. The two effects do not cancel out cleanly. The historical comparison that applies here is the 1999 Howard government's halving of the CGT discount from 100% to 50% for assets held over 12 months. That reform also contained carve-outs and threshold effects. The proximate result was a reorientation of capital flows toward compliant structures, rather than a broad reduction in asset speculation, which was the policy's stated intent. The current reform's super carve-out creates a similar structural channel. For the ASX, the near-term pressure point is managed investment schemes and non-super equity portfolios. The FSC cited managed funds and venture capital explicitly as affected categories. If capital flows out of those vehicles into super consolidated structures, the implied demand for those asset classes shifts at the margin. ASIC receives $17.8 million over 4 years, specifically to strengthen governance and enforcement in managed investment schemes, a budget line that signals the government expects scheme activity to increase, not decrease, under the new regime. The leaning, narrowing toward one variable. The next disclosure that tests this reform's logic is the Treasury's tax expenditure statement, which will need to price the cost of the super exemption against the CGT revenue gain. If that number is larger than the revenue raised by the 30% floor, the equity framing becomes numerically indefensible. If it is smaller, the government holds its position. Watch for the mid-year economic and fiscal outlook. If the revenue modeling on CGT is revised significantly lower, that is the signal that the super carve-out is doing more fiscal work than the headline reform. What would prove the leaning wrong? A marked increase in non-super equity inflows over the next 2 quarters, showing that investors are absorbing the 30% floor rather than routing around it. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.